Good morning. Welcome to 3 Minutes on Markets and Money. I'm your host, Lance Roberts. After a literal bloodbath over the last few weeks, is it time to actually buy the dip? That's the question everybody's got right now. Markets have gotten back down to the 40 and 50-day moving average, just flirting with that level right now. The question, of course, is our buy the dippers going to show up here, push stocks back up towards all-time highs? Markets are getting fairly oversold here on a short-term basis. Again, that money flow buy signal has been in place. It's been pushing stock prices lower, as you would expect. Money flows have declined here in particular. So as we see this process of this money flow working itself off, stocks are beginning to look for support here. The important question is, can they hold this important level of support? A break of the 50-day is likely going to trigger more selling on a short-term basis, and we'll likely see that bigger correction back towards the 200-day moving average. That's currently about 8% lower than where we are now, which would make the total decline about 10%, which would be well within the context of yearly norms, but again, just hasn't happened just yet this year. Looking at the markets a little bit differently, the current advance in the market and this recent decline has worked off some of this overbought condition that we had previously, and we're now getting back to levels normally associated with where we see short-term market buying opportunities. In other words, the buy the dip opportunity. Oversold conditions are approaching those levels here. So another day or two of weakness, if that occurs, you're going to get this much more suppressed on the oversold side, again, providing that fuel for a bounce. And again, that doesn't mean markets are going to go ripping off to brand new highs and start a new bull market. It just means that likely you're going to get a bounce here back towards previous highs at least, if not make slightly new highs. And particularly as we get into the seasonally stronger months of the year, October, November, December, that bias to the upside will become more present. But not just on a daily basis, we're also seeing this oversold condition show up on a weekly basis as well. Again, this kind of bleed in the market. It's been a very slow rolling rotation. Correction has been jumping all around the board. Technology to industrials to basic materials to healthcare, financials, back over to discretionary, and then back to technology. It's just been this real slow roll that's been leading to the sell-off in stocks, but that's also creating this suppression and this reduction in the overbought conditions in the markets. But lastly, the one thing we want to pay attention to is, again, taking a look at this market long term. It's been a very defined uptrend here over the course of the last really year as we start to move into this process. Again, upside remains very contained, downside remains very contained, very defined trend channel across this whole level. Now, again, a correction that breaks this support line is going to start to see a correction back towards this 200-day moving average. Again, plenty of room here for markets to decline, but there's also a lot of support for markets short term. Again, liquidity flows remain high, money flows into markets remain high, optimism remains high, and the expectations and hope that the Fed won't taper also remains high. This leads to this fear of missing out, investors not wanting to miss out on a potential another gain in the market. So again, this keeps providing that support for market short term. So risk is somewhat mitigated at the moment due to the oversold condition. The question will be whether or not buy the dippers can drive this market back up to all-time highs or not. That's going to be the big question here over the next week or so. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. We'll see you back here tomorrow.